The room hums with anticipation as two legends take the stage, Warren Buffett and Charlie Munger, the iconic duo whose investing wisdom has shaped generations. For decades, their Berkshire Hathaway meetings have been more than shareholder events. They're a spectacle of brilliance, wit, and unfiltered truth. Imagine leaning in as Buffett cracks a joke, or Munger drops one of his razor-sharp insights. This is where fortunes aren't just made, but understood. What makes them different? They speak in plain truths, not Wall Street jargon. While others chase trends, Buffett and Munger focus on what never changes: human behavior, economic principles, and the power of patience. Their lessons aren't about quick wins, they're about seeing further, thinking clearer, and avoiding the traps that doom most investors. When they talk, the market listens, and you should too. Today, we're pulling back the curtain on decades of their most powerful conversations. We've sifted through the golden moments, the debates, the laughs, the hard-earned wisdom, to bring you the essence of their success. You'll learn how to spot a business built to last, when to hold tight, and when to walk away, and why the best investment you can make is in your own judgment. This isn't just about stocks, it's about mastering a mindset. Buffett and Munger didn't get rich by accident, they did it by outthinking the crowd, again and again. By the time we're done, you'll see markets differently, not as a casino, but as a game where discipline and clarity always win. Ready to play? To everyone here, thank you. Whether you're a seasoned investor or just curious, you're about to get something rare, wisdom that stands the test of time. So let's begin. The secrets of Buffett and Munger await, and they might just change everything. Meet the legends behind the wisdom. Warren Buffett needs no introduction, the visionary CEO of Berkshire Hathaway and one of history's greatest investors, with a fortune surpassing $100 billion. His timeless wisdom, captured in his famed shareholder letters and the essays of Warren Buffett, has become gospel for investors around the globe. Then there's Charlie Munger, the sharp-witted sage who served as Berkshire's vice chairman and shaped modern investing with his relentless focus on rationality. His classic Poor Charlie's Almanac and legendary talk The Psychology of Human Misjudgment remain required reading for anyone serious about mastering markets and human behavior. Bringing their insights to life is Alex Morris, a seasoned investor and founder of 𝐂𝐶𝐶 Investment Research Service. With a decade of experience as a buy-side equities analyst, a CFA charter, and finance degrees from the University of Florida, he's spent years decoding the principles of investing's greatest minds, and translating them into strategies anyone can use. Together, these three represent the perfect blend of legendary wisdom and real-world application. Buffett and Munger laid the foundation, now Morris bridges the gap between their brilliance and your portfolio. So whether you're learning from the masters or the interpreter of their methods, you're in the best of hands. The lessons ahead aren't just theory, they're the distilled essence of lifetimes spent outthinking the market. Let's begin. Key takeaway 1. The timeless investor, Warren Buffett's simple rules for extraordinary wealth. The wisdom of business: not stocks. Price is what you pay, value is what you get. Warren Buffett. Warren Buffett's greatest investing secret isn't a complex formula, it's a shift in perspective. He doesn't see stocks as ticker symbols to trade, he sees them as businesses to own. At Berkshire Hathaway's legendary meetings, this philosophy unfolds through stories of companies like See's Candies. In 1972, Buffett didn't analyze spreadsheets to buy it, he asked one brilliant question: could anyone with $100 million dethrone See's in California? The answer was no, revealing its unshakable competitive edge. That single insight turned a $25 million purchase into a $2 billion profit machine. The lesson? Master the business, and the market will follow. Your circle of competence, the investor's sweet spot. Know your circle of competence, and stick within it. Charlie Munger. Buffett invests like a baseball batter, waiting for the perfect pitch in his strike zone. When he discovered GEICO in 1951, he didn't just glance at the numbers, he immersed himself in its model because it was simple, durable, and within his understanding. This is the circle of competence in action, the art of ignoring 99% of opportunities to focus on the 1% you truly grasp. Most investors fail because they swing at everything. Buffett thrives because he knows when to wait. Time is the investor's superpower. The stock market is a device for transferring money from the impatient to the patient. Warren Buffett. Here's the market's dirty secret: in the short term, it's a voting machine, swayed by fear and greed. But in the long run, it's a weighing machine, measuring real value. Take Coca-Cola. In 1988, critics gasped as Buffett bought at $11 per share. But he saw what they missed: a timeless brand with global reach. By 2023, Those shares soared 20-fold. The magic wasn't prediction, it was patience. While traders chased trends, Buffett let compounding work. The result? A masterclass in how time turns good decisions into fortunes. Own, don't trade, the mindset that builds wealth. Buffett's edge isn't his IQ, it's his lens. When he buys a stock, he doesn't ask, will this go up next quarter? He asks, would I want to own this business outright? This shift, from speculator to owner, changes everything. It's why he studies annual reports, not stock charts. It's why Berkshire holds companies for decades, not days. And it's why his simplest advice cuts deepest: if you aren't willing to own a stock for 10 years, don't own it for 10 minutes. The takeaway: discipline over genius. Buffett's success proves you don't need brilliance, just discipline. Stick to businesses you understand. Buy with a 10-year horizon. Let compounding do the heavy lifting. As markets gyrate, these principles remain anchors. Or as Munger puts it, it's not supposed to be easy. Anyone who finds it easy is stupid. The path to wealth isn't crowded, because few are willing to walk it. Will you? Key takeaway to the art of valuation: Buffett and Munger's timeless approach to smart investing. The beauty of simplicity in valuation: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Warren Buffett. The greatest investors in history don't rely on complex formulas, they think in clear, fundamental terms. At Berkshire's annual meetings, Buffett and Munger repeatedly emphasize this truth: if you need a calculator to determine value, you're probably overcomplicating things. Their approach? Simple estimates of future cash flows combined with the patience to wait for the right price. This straightforward method has consistently outperformed Wall Street's most sophisticated models. Ancient wisdom meets modern investing. A bird in the hand is worth two in the bush, but only if you know when you'll get them and what interest rates are. Warren Buffett's twist on Aesop. Buffett's concept of intrinsic value builds on this ancient fable, adding two crucial modern considerations: time and interest rates. This framework guided Berkshire's acquisition of See's Candies, a business whose true value wasn't in its financial ratios, but in its predictable cash flows and unshakable brand loyalty. While traditional metrics might have overlooked it, this bird-in-hand philosophy revealed a golden opportunity. The power of cash flow kings. See's Candies couldn't reinvest massive amounts of capital, but what it could do was generate consistent cash that Berkshire could deploy elsewhere. This became the blueprint for Buffett's investments, businesses that serve as perpetual cash fountains. The lesson? True value creation comes from understanding a business's fundamental economics, not chasing growth for growth's sake or obsessing over market multiples. Beyond the numbers, the qualitative edge. While most investors fixate on PE ratios and book values, Buffett and Munger look deeper. They search for durable competitive advantages, what Buffett calls economic moats, and exceptional management teams. Their experience proves time and again that a wonderful business at a fair price will outperform a mediocre business at a bargain price every time. This qualitative lens transforms good investments into extraordinary ones. The margin of safety, your investing seatbelt. Buffett illustrates this crucial concept with a bridge analogy. Would you rather cross a 10,000-pound rated bridge with a 9,800-pound load or a 4,000-pound one? The answer is obvious, and so is the investing principle. During the 1973-74 market crash, while others panicked, Berkshire's margin of safety allowed them to acquire stakes in strong companies at steep discounts. This discipline turns market chaos into opportunity. The discipline of doubt. It's not supposed to be easy. Anyone who finds it easy is stupid. Charlie Munger. Valuation isn't about precision, it's about being approximately right where others are precisely wrong. Detailed spreadsheets didn't reveal See's Candies' true worth, understanding its pricing power and customer loyalty did. This clarity, combined with the discipline to act only when price and value diverge significantly, has guided Berkshire through decades of market cycles. The challenge isn't in the math, it's in maintaining the courage of your convictions when the crowd disagrees. Key takeaway 3: Capital deployment, the art of putting money to work like Buffett and Munger. The 3 pillars of smart capital allocation. The difference between successful people and really successful people is that really successful people say no to almost everything. Warren Buffett. Valuation opens doors, but capital deployment walks through them. At Berkshire Hathaway, Buffett and Munger perfected a 3-part formula for putting money to work: ruthless opportunity cost analysis, ironclad investment criteria, and an unshakable commitment to capital preservation. This triad transformed a failing textile mill into a $800 billion empire. The secret? They don't just invest, they choose not to invest 99% of the time. Opportunity cost, the investor's true north. During the 2008 financial crisis, while others hoarded cash, Berkshire deployed $25 billion. Why? Because Goldman Sachs at 10% preferred dividends and GE at bargain prices weren't just good deals, they were better than every alternative. This is opportunity cost thinking at its finest. Every dollar spent on X is a dollar not spent on Y. As Munger says, the big money is not in the buying and selling, but in the waiting. Berkshire waits until one opportunity clearly outshines all others. Buyback discipline, the shareholder's litmus test. Most companies repurchase shares like clockwork. Berkshire does it like a sniper. Their rule? Only when shares trade below 120% of book value. In 2012, when Berkshire finally initiated buybacks after decades of waiting, it sent a powerful message: we only act when each dollar spent creates more than a dollar in value. Contrast this with typical CEOs who buy back stock to prop up EPS regardless of price. As Buffett quips, when management buys a business it doesn't understand, it's the shareholders who need protection. The forever mindset, acquisition as stewardship. Berkshire doesn't just buy companies, it adopts them. The 1972 See's Candies purchase set the template: keep the founders, preserve the culture, and never force synergies. This approach made Berkshire the buyer of choice for family businesses like Duracell and Dairy Queen. While private equity firms strip assets, Berkshire builds moats. The result? A pipeline of quality deals others never see. We don't tell .400 hitters how to swing, Buffett says of his acquired management teams. Preservation before profit, the insurance lesson. When national indemnity's insurance markets turned toxic in the 1970s, they did the unthinkable, slashed volume by 80%. This patience created a war chest to dominate when markets recovered. Like a baseball batter willing to let 100 pitches go by, Berkshire knows capital preserved today compounds tomorrow. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Buffett's famous maxim isn't about avoiding risk, it's about avoiding permanent loss. The human factor, rules need right players. Even the best system fails without exceptional operators. Berkshire's secret sauce? Finding managers who treat the business like their life's work, then getting out of their way. From See's Candies' Chuck Huggins to BNSF's Matt Rose, these partners thrive with autonomy. As Munger observes, show me the incentive, and I'll show you the outcome. At Berkshire, the incentive is ownership in every sense: financial, emotional, and generational. This disciplined yet flexible framework explains how Berkshire could sit on $150 billion in cash, not out of fear, but because nothing else met their standards. In investing as in life, the hardest choices are what you don't do. As Buffett says, the stock market is a no-called strike game. You can watch pitches come in for years without swinging. When you do swing, make sure it's within your circle of competence, at a price that guarantees a margin of safety, with capital you can afford to leave invested for decades. That's not just investing, that's capital deployment as high art. Key takeaway 4. The Berkshire Blueprint: how Buffett and Munger built a culture that outperforms. Character over credentials, the Berkshire hiring test. In looking for people to hire, you look for 3 qualities: integrity, intelligence, and energy. And if they don't have the first, the other 2 will kill you. Warren Buffett. Berkshire's management philosophy defies corporate norms. While others chase Ivy League pedigrees, Buffett searches for something rarer: unshakable character. The Salomon Brothers scandal of the 1990s became their defining lesson. When a bond trader's deception nearly destroyed the firm, Buffett learned that brilliant minds without moral compasses become liabilities. Today, every Berkshire manager knows: lose money and you'll get understanding, lose reputation and you're gone. This uncompromising standard creates what Munger calls a culture where the rats never get invited to the party. Pay for performance, not gamesmanship. While Wall Street obsesses over stock options and complex bonuses, Berkshire keeps compensation refreshingly simple. At GEICO, bonuses tie directly to policy growth and underwriting results, metrics managers actually control. Contrast this with typical corporate pay structures that Munger acidly describes as paying people to lie, cheat and steal. Berkshire's approach proves a radical truth: when you align incentives with real value creation, you don't need 50-page compensation plans. The power of radical decentralization. Imagine running a $800 billion company from an office with fewer staff than a Chipotle. Berkshire's 25-person headquarters oversees 400,000 employees through what Buffett calls extreme delegation. When they bought Nebraska Furniture Mart, 89-year-old Rose Blumkin kept running the show from her same battered desk. This isn't neglect, it's a brilliant filter that attracts self-motivated entrepreneurs who chafe under corporate bureaucracy. As Buffett says, we don't tell .400 hitters how to swing. The newspaper test, Berkshire's ethical North Star. After Salomon, Buffett instituted his famous newspaper test. Would I be comfortable if this decision appeared on tomorrow's front page? This simple heuristic outperforms 1,000-page compliance manuals. Combined with Berkshire's famous patience, they never pressure managers for quarterly results. It creates an environment where doing right beats looking good. The result? Managers who think like owners because they're treated as such. Succession through systems, not saviors. Most companies crumble when founders leave. Berkshire built an anti-fragile culture instead. By creating permanent homes for businesses, no reselling or restructuring, and promoting from within, they've made the organization bigger than any individual. When Buffett eventually steps down, managers will keep running their businesses exactly as before, just sending their excess cash to a new capital allocator. This continuity attracts leaders who care about legacy, not just paychecks. The structural advantage. What holds this unconventional approach together? Berkshire's unique corporate architecture, part holding company, part permanent capital vehicle, part partnership culture. Unlike pressured public CEOs, Buffett can wait decades for results. Unlike private equity firms, he never forces exits. This structure creates what Munger calls the ultimate ecosystem for rational capital allocation. The lesson for investors? Culture isn't soft stuff, it's the hardest competitive edge of all. As Buffett puts it, culture, more than rule books, determines how an organization behaves. In an era of corporate scandals and short-termism, Berkshire stands as proof that when you combine ethical people with sensible systems and extraordinary patience, the financial results take care of themselves. The final piece? Understanding how this entire machine fits together, which brings us to Berkshire's most underappreciated advantage. Transition to next section. Key takeaway 5: The Insurance Edge, how Berkshire built its $165 billion secret weapon. Float, the ultimate competitive advantage. Our insurance companies have been the engine behind Berkshire's growth. Warren Buffett. What began as an $8.6 million acquisition of National Indemnity in 1967 became Berkshire's not-so-secret weapon, a $165 billion float machine. Unlike typical insurers who cautiously invest premiums in bonds, Berkshire treats this money like permanent capital, a financial superpower allowing them to swing at pitches others can't reach. Imagine a bank where depositors promise never to withdraw funds, then multiply that by 100. That's Berkshire's insurance advantage in action. The dealmaker's dream, capital that says yes when others freeze. When AIG needed to offload $10 billion in liabilities or Lloyd's of London required a backstop, only one player could answer the call. Berkshire's unique position as the financial Fort Knox creates a virtuous cycle: more trust begets more unique opportunities. As Munger observed, we've had better deals come to us by just sitting than by going out and finding them. Their insurance float isn't just money, it's a market-moving privilege earned through decades of discipline. Discipline over dollars, the art of saying no. During insurance market downturns, National Indemnity did the unthinkable, cutting premiums by 85% rather than chase bad business. While competitors sacrificed underwriting standards to meet quarterly targets, Berkshire absorbed short-term pain for long-term gain. This counterintuitive move, Buffett notes, takes a rare combination of patience, courage and discipline, qualities most public companies lack but Berkshire cultivates religiously. The Ajit Jain effect, talent meets opportunity. The Saturday morning in 1985 when Ajit Jain walked into Buffett's office with no insurance experience marked a turning point. Armed with Berkshire's capital and his own mathematical genius, Jain built a reinsurance operation that rewrote industry rules. His signature move? Writing policies so large and complex that only Berkshire could handle them, like a $1 billion earthquake policy for California. As Buffett jokes, if you see Ajit coming, it means something really bad is about to happen to someone. The patient turnaround, fixing Gen Re's culture. Even Berkshire stumbles. Their 1998 Gen Re acquisition initially brought underwriting and reserving problems. But unlike typical firms that panic and sell, Berkshire spent years patiently rebuilding underwriting discipline. The result? A phoenix-like resurgence proving their model's resilience. This patience stems from what Jain calls the Berkshire mindset, We don't manage quarters, we manage decades. The uncopyable formula. With 4 times more capital per premium dollar than rivals, Berkshire's insurance operations represent what Buffett calls the ultimate business model. It combines 1. Permanent float at near zero cost. 2. Once-in-a-generation talent like Jane. 3. A culture that prizes underwriting discipline over growth. The kicker? As Buffett notes, this advantage compounds over time in a way competitors simply can't replicate. While others see insurance as a commodity business, Berkshire transformed it into their crown jewel, not through financial engineering, but through what Munger calls the disciplined application of uncommon sense. This insurance edge fuels everything else in the Berkshire empire, creating a money machine that grows stronger with every market cycle. The lesson? In business as in investing, the real magic happens when structural advantages meet human brilliance, and no one blends them better than Berkshire. In summary, the book Buffett and Munger Unscripted delves deep into the untold wisdom behind the world's greatest investment duo. The accidental meeting that changed investing forever. Picture Omaha, 1959, a young Warren Buffett, already an investing prodigy, gets introduced to a sharp-eyed lawyer named Charlie Munger at a dinner party. Their conversation lasts hours, sparking a 60-year partnership that would build an $800 billion empire. This book captures their unfiltered genius, straight from decades of Berkshire Hathaway meetings where they transformed complex finance into simple, timeless lessons. The See's Candy Secret: How $25 million Turned into $2 billion. Buffett's 1972 purchase of a small California candy company revealed his entire philosophy. While Wall Street obsessed over metrics, he asked one question: could anyone with $100 million steal See's customers? The answer was no, proving that real investing isn't about spreadsheets, but understanding unshakable competitive advantages. This became Berkshire's blueprint: buy wonderful businesses at fair prices, then let compounding work its magic. Float, the $165 billion free money hack. Most insurers cautiously invest premiums in bonds. Berkshire? They turned insurance float into a secret weapon, using $165 billion of other people's money to buy stocks, entire companies, and crisis-era bargains. The kicker? Their discipline to never chase risky policies, even if it meant an 85% sales drop, made this advantage unstoppable. The Ajit Jain effect: How a Math Genius Rewrote Insurance Rules. In 1985, a soft-spoken Indian engineer named Ajit Jain walked into Buffett's office with zero insurance experience. Soon, he was writing $1 billion earthquake policies and insuring Michael Jordan's knees, deals so bold only Berkshire's balance sheet could handle them. Jain's rise embodies their talent formula: find brilliant people, give them autonomy, and get out of the way. Salomon scandal: when Buffett saved Wall Street, and learned a brutal lesson. 1991, a rogue trader at Salomon Brothers nearly triggers a financial meltdown. Buffett steps in as interim CEO, firing top execs and posting his personal number on trading desks. The lesson? Lose money, I'll understand. Lose reputation, and I'll be ruthless. This crisis cemented Berkshire's culture-first approach, where integrity isn't policy, it's survival. The 2008 masterclass: How Fear Becomes Fuel. While banks collapsed in 2008, Berkshire deployed $25 billion into Goldman Sachs, GE, and others, with terms so favorable they'd make a loan shark blush. Munger's insight? Opportunity comes dressed in overalls, looking like work. Their secret? A war chest of cash and the patience to wait decades for the perfect pitch. Why Berkshire's next chapter might be its best. With Buffett now 93 and Munger 99, skeptics ask, can Berkshire outlast its legends? The answer lies in their anti-fragile design, decentralized businesses, owner-operators, and a culture that values stewardship over shortcuts. As Buffett says, our managers don't need me, they just need the system we built. Your turn, join the Berkshire mindset. If this book taught one thing, it's that great investing isn't about IQ, it's about temperament. Now, a tiny favor: if these lessons resonated, tap that like button. It helps others discover this wisdom. Share it with a friend who needs Munger-style clarity. And subscribe because you're part of a community that values growth over get-rich-quick schemes. Here's the truth: no one says enough, you matter. You're worthy. And the fact you're working on yourself? That's what makes you unstoppable. Now go forth and think like an owner. Buffett and Munger would approve.